If you're bullish on gold, you've had a pretty rocking time over the past year, in fact, probably over the past 5 years. But gold has its cycles. Another very interesting ancillary play on gold is gold miners. Are you able to get much higher returns?
So the top 10 gold miners have given guidance that for the next 3 years, their gold production will not grow by more than 1% per annum. So in short, there is no supply. There was a worthy and credible alternative that emerged to gold at the time, and so there's a reason that it went through that kind of massive bear market.
Now, you're not directly betting on gold, rather you're betting on gold miners.
Yes.
And that too, small cap gold miners listed in Canada and the United States.
Yes, that's right.
On that point, would you call Bitcoin a worthy and credible alternative? Hello and welcome to the Global Investing Podcast. I'm your host, Neil Borate. If you're bullish on gold, you've had a pretty rocking time over the past year, in fact, probably over the past 5 years. But gold has its cycles. Another very interesting ancillary play on gold is gold miners. Are you able to get much higher returns by investing in those companies? India already has a domestic fund which invests in gold miners around the world, the DSP World Gold Fund. But unfortunately, that fund is closed for fresh inflows. So the other option, which is newly opened up by a small AMC in Gift City called Rational Asset Management, also invests in gold miners. And today I have with me the advisor to that fund, Vivek Iyer, who also runs a domestic AIF focused initially on small caps. But Vivek will tell you all about that. Vivek, welcome.
Thanks, Neil. Glad to be on the show.
Thanks, Vivek. So first, if you can give us a brief on your career and how you got to this stage.
Sure. So I don't actually have any formal background in investing. I was a startup founder. I founded a laundry services company. So we put up a factory, built an app. It was called One Click Wash, and we would pick up people's laundry and process it and deliver it back. Couldn't make too much of a success of that, but essentially that was also the time when I got involved in sort of thinking about the family's finances, right? And we were predominantly, as most families in Bombay are, we were 100% invested in Mumbai real estate, right? Our own home investment properties. And at the time in 2013, rental yields were around 2.5%. So I found that quite risky. And that sort of started my exploration into equity. So I ended up buying my first stock in 2016 and had an amazing learning curve where, there was the euphoria from 2016 to 18, where there was a big bull run in small caps. And then in 2018 was the IL&FS crisis, and you had a massive small cap crash. So gave up and all and more of the profits that I had made. And cut to 2020, essentially, over the preceding 7 years, my family, we had sold all of our real estate, and my father had retired just then. His last role was as CEO of Walmart India, and I had just quit my job, and we're both sitting at home, and the lockdown is announced. And the stock market starts falling. So Nifty starts falling from 12,000, 11, 10, 9, and bottoming out on 23rd March 2020 at 7,500. So at that point, we sort of thought that if ever there's going to be any normalcy, then this is a once in a lifetime opportunity. So we started investing through March 2020 as a family office, just our own money. And we became 100% invested by November 2020. And that was the genesis, our entry into the world of equity markets in India. And obviously, anything that anyone would have picked up at that time has done extremely well. And then friends and family seeing that, they sort of said, why don't you put up a vehicle where we can invest alongside you? So in March 23, we applied for and we got a Cat 3 AIF license, and we launched our first scheme, which was a closed-ended scheme, and then subsequently a second scheme in April 25. And so, in those two schemes, we manage a combined AUM of about 140 crores, which is largely with a bias towards small and mid cap.
Right.
More with a value tilt.
Right. So between 2020 and 23, how many X did your portfolio jump?
So I think roughly over the last 5 years, we've compounded about 50% per annum.
50.
Yes.
You say that very normally. Like,
No. I mean, see, I would say a lot of this is luck and serendipity. The fact that we had that much cash available, we were both sort of free to think about it. Otherwise, normally you're engaged in your job and you're not even thinking about it so deeply, right? It's like it comes, it passes you by, and the opportunity. Just a lot of serendipity leading to that. I think not all of it can be attributed to our own skill.
yeah, but you did get the timing right. Okay, so it's been 2 years since you've been running these two domestic AIFs. And then at what point did you get this idea about gold miners?
Sure. So I'm more of a value-oriented manager, and honestly, the last 2.5 years, although we've done decently, but they've been rough from a value perspective, right? I'll tell you why. Because really, the stocks that have done well are very much what you might call cash guzzlers. So, whether it's in the energy theme or it is in order book investing like defense or shipbuilding PSUs or, PSU banking. These are themes where you are really, counting on the cash flows eventually coming back, and that is a leap of faith we usually don't take. So we found it rather difficult, although we are fully invested and we have found niches, but it's not been easy. And I think around December 23, Jan 24, we found the markets to be exceptionally expensive and opportunities really rare. So that is what sort of took us looking abroad. Also, my brother's a UK citizen. So there's a natural requirement of expenses abroad. And we've always been thinking, what is that opportunity that we can keep money abroad and invest in, which will also give us a decent return. And that is really the time that the Chinese central bank had been buying gold at an unprecedented rate. I think like at something like 15 or 20 times the normal rate at which they buy, they had bought in 2023. So that was something very unusual that we noticed. We did a deep dive into gold. We were very excited by the opportunity. We liked miners even more, and that's how this whole thing got started in December 2023.
Right. And you initially invested through other vehicles also.
Correct. So we have invested in the DSP World Gold Fund of Fund. We've invested through LRS as well. So we initially just invested, in our own name through the family office, and we applied for the Gift City license, and we got it in May 25, and we launched the fund on 30th May 2025. So it's been 3.5 months.
Right, and it's about $3 million.
It's about $3 million right now.
Right. So Vivek, let's do a deep dive into the thesis. Gold is ultimately a cyclical commodity.
Right.
Some people say it's a dead asset. It does not yield any dividends, any rent, any kind of income stream. And the cycles can be painful. So the most recent bear cycle was 2012 to 18. And I've been through it. I've been a gold investor for a long time. So it's easy to look back and think, 6 years and after that, how gold has rallied. But when you live in those years and you underperform, it hurts. So what was your thinking when you must have studied these cycles?
Absolutely. So actually, this was a very benign cycle. The most brutal cycle, the one that I think everyone fears a recurrence of, is the cycle from 1980 to 2000, which was a 20-year bear market. Gold topped out at $850 an ounce and fell to $250 an ounce. That's a 75% fall in a 20-year bear market. But I think, as you said, right, let's just go back to the basics. You said gold is a cyclical commodity. So let's treat it like that. Let's treat it as a commodity. Let's forget about the macro part of it for the time being. Let's just treat it as a commodity. So in the best part of gold as to study as a commodity is that usually in most commodities, whether it's say oil, iron ore, and so on, you need to really look at the supply side, right? And this is what generally the biggest worry comes from: massive expansion of supply. Now, the great thing about gold is you don't have to worry about that at all. So gold supply roughly expands at about 1% per annum. So there's about 320,000 ounces of gold mined in the world, and about 3,200 tons is added every year, right? So 1% is what the supply is expanding at. And what is that supply growth looking like, right? So the top 10 gold miners have given guidance that for the next 3 years, their gold production will not grow by more than 1% per annum.
Wow.
So, in short, there is no supply. There is no worry that there will be this sort of, in any other maybe asset or commodity, if you had a doubling of the price in 2 years, you might suddenly see massive amounts of supply coming online.
If I may, what about scrap gold? And there are sometimes news reports that somebody will discover a process that makes synthetic gold. How credible is that?
So, synthetic gold, essentially, what has happened is there has been a simulation which a startup has done to produce during that simulation. It's not reality, they've never actually executed it. They, for a few seconds, they produced a few atoms of gold. And their thesis is that if fusion energy can result in the production of gold, and if the price of gold were to go to $100,000 an ounce, which by the way is 30 times more from where it is today, then that would make fusion energy sustainable. So it's there's a many if gold is going to $100,000 an ounce, we are all fine as gold investors.
So it's prohibitively expensive to do that process.
At the moment it's not feasible. It's not even the realm of reality. If through massive scientific breakthroughs in the next couple of decades it were to be, it would be prohibitively expensive. So it's just a distant dream as of now, right? And as you said, so the 3,200 tons of gold that comes online every year, it comes from two sources. 2/3 comes from gold miners and 1/3 comes from gold recyclers. Right?
Scrap.
Yes. They are the ones who provide the supply of new gold into the system, right? And who consumes this gold, right? So the biggest is jewelry demand. So about 2,000 tons a year. This year is going to be much lower because prices are so high. Jewelry demand drops off. Jewelry demand will never go to zero, right? But so it's just that instead of buying 22 carat, I'll buy 18 carat. Instead of 18 carat, I'll buy 14 carat. But I will buy. And so that's the largest buyer, right? The second is technology demand, which is roughly 300 tons a year, and that is sort of price agnostic, because the trace amount of gold in your iPhone is not Apple. If they could have discontinued it, they already would have, right? Yes. So that is immaterial. So who remains, right? So the third are the central banks. So the central banks have been buying hand over, and what I mean by that is they have been buying at a run rate that is 4 to 5 times that of the previous decade, of their annual buying over the previous decade, right? So the Chinese central bank was the star in 2023, and the other central banks, Polish, Kazakhstan, India, they were the stars in 2024 in terms of buying gold very, very aggressively.
India as well.
Yes. And now in 2025 comes the fourth buyer, which is investment demand. So investment demand in the first 8 months of the year is already crossed about 1,000 tons or 1,200 tons it's crossed, which is the highest in the previous 20 years for the full year. So we are already at a run rate where this is going to be the highest ever year of investment demand. So this year, the big jump that has come has been driven by investment demand, by ETFs, largely by ETF buy, right? So in a way, you could say retail has entered the party, right?
But isn't that always the last stage of a cycle?
So it depends, right? I mean, if you look at India, so what retail has done is essentially hold off FIIs for more than 5 years. They've held aloft this market for FIIs because the fundamentals were good. So it depends, right? It depends what is the opportunity, what is the it's one of those truisms which not necessarily always there are exceptions to it, right?
So basically retail can party for a long time.
Very long time. That Indian retailers have proven. And if I were to talk about what is the size, as in, so Goldman Sachs put out a report recently where they said that if 1% of treasury holders switch to gold, or if treasury holders switched 1% of their holding to gold,
US treasuries,
gold would be at $5,000 next year. So that's how minuscule gold as an asset class. Gold as an asset class in 1990 was 25% of world assets. Today it's 1%, gold and gold miners. So it has been completely marginalized in our, basket of assets at a global level. I would say India is still a massive exception because our households have in their wisdom continued buying gold for the last so many decades, and I believe it is still at a 15 to 20% level. But at a global level, it's minuscule.
Could you just repeat that line? Gold has gone from 25% of world assets.
Yes, in 1980 to 1% today, gold and gold miners.
So that bear market from 1980 to 2000 destroyed gold so much, not just in absolute terms, but in relative terms,
Precisely.
that it went from sizable chunk to
Precisely. And why should an asset become so unloved? Because it has a very worthy competitor. So who was the competitor? The US dollar, right? So in from 1982 to 2000 was the era of globalization. So you have the US, you have a unipolar world, you have a country which is opening up its markets, allowing you to freely sell there, helping you build out manufacturing capacity in your country, providing military support to ensure global trade happens peacefully, and at all the while paying anywhere between 4 to 10%. Actually, in the 80s, at one point, they were paying 18% on their bonds. So why would you not rather hold this than pet rock, as once Jason Zweig called gold a pet rock, right? So there was a worthy and credible alternative that emerged to gold at the time, and so there's a reason that it went through that kind of massive bear market.
on that point, would you call Bitcoin a worthy and credible alternative?
So while I've been a startup founder, I'm not a startup investor, and I still believe that Bitcoin is a startup. It's still young. Its investor base is nowhere of the credibility that gold has. It is not a competitor to the US dollar as a reserve. It is positioned as one. It may well become one. I don't know. I don't forecast the future. But today it's not. As of today, it is not a competitor.
Okay. Okay. Now, you are not directly betting on gold, rather, you're betting on gold miners.
Yes.
And that too, small cap gold miners listed in Canada and the United States.
Yes, that's right.
Could you elaborate on that?
Sure. So, like in any commodity cycle, especially when it is coming out of a deeply cyclical period, so gold actually saw the worst of it by 2015. And even the gold bear market was not so bad. It topped out at about $1,800 an ounce in 2011, and it fell to about $1,000, right? So it fell about roughly 35-40%, which is rough, but not cataclysmic. Gold miners, the story was totally different. So gold miners in 2008 and 9 went on this massive capex and acquisition binge, all debt fueled, right, as an asset class. And so when the bottom fell out of gold, many of them went bankrupt. So either they had to do massive equity dilution to retire that debt and stay afloat, or they went bankrupt and had to be literally bought out of bankruptcy. And so, I mean, you'll see many of them where equity erosion has happened to a 99% level. And so they have only really come out of the cycle a couple of years ago, where gold has started recovering for nearly a decade now. But their down cycle was so bad and so severe that until 2023, they were trading at, below book value, at very, very low valuation. So the pessimism in that sector is far more extreme than, I would say, the pessimism in gold as a commodity. And that is where sort of the opportunity lies, right? Which is because when the operating leverage plays out the other way, then gold may go up, say, $100 an ounce, but essentially these companies, when we bought them, they were break even. Their cost of production was all in sustaining costs is what it's called, was about $1,800 an ounce, and the price of gold was $1,800 an ounce. So when gold went up $500, essentially these companies went from break-even zero ROC companies to like 30-35% ROC companies, right? So it just transforms, right? And you will see this across any commodity. And that is where the opportunity lies, because this is still the case. The pessimism, I would say, to a great extent has been removed in the large cap miners. So say a Newmont trades at about 10 times free cash flow, which is, I believe, still cheap because of the opportunity in gold. But say gold is going nowhere. Gold 3,500 is our ceiling. It's going nowhere. Then I would say Newmont is roughly fairly valued. But there are several other miners, as always happens, right, that the pessimism recedes last in the small cap and mid cap space, right? and it's similar to, say, India's bull market. Say if you bought, say, HDFC Bank 3 or 4 years ago, maybe it's not been you've not done that well as you might have hoped. But if you bought the right NBFC or the right small cap bank, then the returns have been astronomical. So that's where the opportunity lies, where our top 5 holdings currently trade with, assuming a spot gold of $3,500 an ounce, trade at 2.6 times free cash flow. And this is where, I mean, they have gone up between 2 and 4x this year so far.
Right.
So after a massive run up, they are still extremely cheap, and gold continues to rise. So actually, in the last, I would say, month, gold has risen faster than the miners, whereas usually in this part of the cycle, miners really start outperforming. So we feel that the runway for gold itself is pretty long, and for these miners, I think the opportunity is immense.
Yeah, you're estimating a 7,000 USD price per ounce by 2030.
That's our estimate.
Okay. You also have some silver miners.
Yes.
What is the case there?
So usually when you buy a gold miner, gold and silver mines, gold and silver is mined usually in the same mine. And typically they will produce both, right? So, but the way we have aligned ourselves is sort of with a portfolio that is 80% towards gold and 20% towards silver. Because what we feel is that, silver, while it may not have all the upside from, the reserve asset proxy and so on, but the dislocation between gold and silver prices has become so massive that it's just a tremendous value buy. And there is a supply crunch there as well. So you have the supply crunch, which is the base of what we always want in a commodity, and the dislocation where we feel that if silver simply reverts to the median, then we will have massive upside even from that 20% exposure.
The median of the gold silver ratio.
Yes. It is at such an extreme right now that even a median reversion would mean, a 3-4x move in silver from here.
The counter to that usually is that a lot of silver's demand, in fact, the vast majority of silver's demand is industrial.
That's right.
Rather than ornaments and precious metals.
That's right.
So does it still square off with what you're suggesting?
So I think that even that demand will continue to be there, right? And that, unlike, say, jewelry demand, is little more, may not be that price sensitive. So again, right, for us, it's even at the current levels, our miners are making a lot of money on silver. We've kept that 20% exposure simply because we feel that at some point, even the investment demand will start, maybe not the central banks, but the retail investment demand may start looking at silver as a proxy. I mean, at a 100, 120, 130x, am I thinking, should I not just have some silver?
Yeah. It's often called the poor man's gold.
Exactly. So I think, I feel like gold will just drag it up alongside at some point.
What about other precious metals, like a platinum, for example, or a palladium?
So because they are mined separately, I think we haven't really looked at them as an exposure. We've stuck to silver and gold, right? So silver as a very direct proxy of gold, and gold being the main thesis. And we've not then sort of diversified beyond that. So we'd rather focus where we have the most confidence and certainty.
Fair. All right, final question, Vivek. How does one invest in your AIF?
So it's there's a minimum $150,000 investments prescribed by IFSC. And it's very straightforward, but even accredited investors can invest. We have a lower minimum for them.
How much is that?
50 lakhs. So
50 lakhs INR.
50 lakhs INR, yes. We are always happy to have people come on board.
All right. Vivek, thank you so much.
Pleasure. Thanks, Neil.